Welcome back, everybody, to More Wealth Retirement Talk. I'm Dave Moore here with Shawna and Jacqueline. Today, we're diving into a topic that tends to bring out a lot of strong opinions: annuities versus investments. And depending on who you talk to, you'll hear completely different answers on what you should be doing. So what we want to do today is slow that down a bit and just have a real conversation about what these actually are, what they're designed to do, and how they may fit into a retirement plan. Because ultimately, this isn't about picking sides. It's about making confident, informed decisions with your money. All right. Well, before we get into that, how is everyone doing today? Let's start with Jacqueline.
Oh, I'm so good. You guys just make me laugh. I mean, I don't even know if we should be telling our listeners this, but here we are barking like dogs, trying to see who can do the better barking impression. This is just great. We have so much fun.
Talking about narwhals and polar bears and dogs. Yeah. Go figure. Go figure.
You all don't want to know what has been said before we hit the record button. I promise you.
Exactly.
Maybe they do.
Hey, I do have to say, though, in Minnesota today, it's 86 degrees.
Ooh, wow. Get sunscreen out, you guys.
That's pretty warm.
That's about what it is here. That's cool here.
Probably here and Tennessee.
Yeah, but still, that's got to feel so good.
It does. I need my blonde hair back, you know?
Mm-hmm. You should be outside.
Yeah.
You should be doing the podcast from outside today.
Sun.
That would be awesome.
Ooh.
Yeah.
Get me a Ethernet cable out there.
Perfect.
We could do
We'll
that.
send one to you.
We're going to do one outside one time.
Yes. How are you guys today?
We're doing well. We have a lot going on coming up. This is like a week or two of a lull that ends next weekend because we are going to be at Morgan Wallen in Las Vegas next weekend.
Yes, we are.
Yeah.
Oh, so jealous.
Then we come home and we have graduation.
Yep.
We have a couple award ceremonies in between because she's earned it.
And then we're taking the kids.
Then we're taking the kids to Disneyland.
Yep.
Fun.
So we got a wild May, and then somebody's very happy birthday is in May.
We're so early for that. You can mention
We're never
that
too early
week.
for your birthday, Shauna. Never.
No, it's birthday month. We all know that.
Birthday month.
It's birthday month.
It's not May yet.
It doesn't matter. We start April 10th. We start. So it's your birthday month. And then she extends it to June 10th. So Shauna the Queen gets 2 months. Yep.
Don't believe him.
And considering this year, it's doubled up on Mother's Day. No, you get your own month. We're making up for it by giving you a month.
Yeah, I think every other day, but that day we'll celebrate her birthday. We will celebrate that day, though.
You are all too much, but thank you.
You deserve it.
We love you, so that's why we're doing it.
I love you all too.
I'm sure we'll have a special birthday podcast within a
probably something embarrassing. I'll prepare.
More than likely, yes.
Yep.
Yeah, I'm not going to lie.
So anyway.
Well, let's dive into this episode.
Welcome to More Wealth Retirement Talk, where finance meets fun.
Join financial expert Shawna Moore,
sports analogy pro and dad joke king Dave Moore,
and Jacqueline Gladhill, who keeps us all on track
as we break down retirement planning with insights,
laughs,
and a whole lot of more wisdom.
All right, so let's start with how a lot of people are already thinking about this. If you've spent the last 20 or 30 years investing and you've seen the market work over time, it's natural to assume that same approach should carry you into retirement. And on the surface, that seems reasonable, right? The question is, does that approach still work the same way once you're actually relying on that portfolio for income?
Yeah, Dave, that's a really good question. And I think a lot of people assume retirement is just a continuation of what they've always just done. But Shawna, what tends to change for people when they shift from saving to actually living off their money?
Well, that's a pretty loaded question, actually. There's a lot of things I can go into on that. But I mean, when you retire and you no longer have that paycheck, you shift from the accumulation phase into an income phase. So instead of adding to and saving into your retirement accounts, now you're going to start drawing from that. You need that source for income to replace the paycheck that you no longer have. And so what a lot of people don't realize is that there's the sequence of returns, meaning, when you retire, is the market going up right away? When you retire, do you have a market downturn or correction? And so that sequence of returns risk while you're working for all those years doesn't really have that kind of effect on your retirement. But when you start taking income out, like what we've experienced the last couple of months, there's a big difference when the market's down and you're taking money out, you're selling your positions, your investments in the market for income. So when you retire, timing matters much, much more than your average returns. And most people still focus on the average returns. But when you retire, you have to shift your thinking, because in retirement, you're replacing a paycheck.
Mm-hmm. Paycheck replacement.
So
for sure.
true.
Mm-hmm.
Yeah. Well, let me ask it this way. When annuities come up, a lot of people already have pretty strong opinions. It's usually something like, hey, they're complicated, they're expensive, or I've heard to stay away from those. That's the popular one, right? And I'm always curious, are those opinions coming from actual experience or just things that people have heard over time?
Great question, Dave. And is that based on reality, Shawna, or is it just perception from maybe the past experiences?
Well, I think there's a lot of misconceptions about it. And what a lot of people don't realize is, not all annuities are the same. There's some good annuities. There's some not so good or bad annuities. There's older annuities. So kind of like investing in the market, there can be some really good stocks, and then there can be penny stocks or high risk investments. There's good bonds, and then there's junk bonds. So they're not all the same. And I think the bad reputation comes from a lot of the older products that they had 20, 30 years ago when I started the business. Annuities were a lot different. So they're going from past experiences. A lot of it is perception. There's a lot of misinformation out there, or just a lot of conflicting views out there. Sometimes it's from, advisors that are more fee-based and they only invest in the market, that might be giving advice that maybe they aren't aware of the good annuities that are out there. Some are fee-based, some have market risk. There's a lot of different types of annuities. So it's really about finding the right one that might fit your situation, and making sure that it actually fits your situation. Not everyone needs an annuity, but it's really breaking down the different types, knowing what that does and doesn't do for you. And they can really work like a pension. So, a lot of people, they really like their company pensions. And what they don't realize is that most of those company pensions are offered through group annuities that you can purchase individually on your own. And so there's a lot of just misconception out there, I believe.
That's a great point. So to kind of flip the thinking here, so we discussed annuities. Now let's talk about investments and looking on the other side for a minute. So Dave, what do you hear from people who are fully invested in the market?
Good question, because we hear this pretty often. A lot of people who are fully invested tend to say things like, the market has always come back over time, so I'm not too concerned. Then it's usually followed up with, as long as I'm only taking out a small percentage each year, it should last. And I think the thinking really comes from what's worked for them while they were building their wealth. But I don't know that everyone has really thought through what it looks like once that portfolio actually has to start producing income.
Well, so do you think that people fully understand the risks that come with that? I mean, with the market, or do they just get used to that mindset?
I honestly think that they're used to that mindset. And a lot of it, there's a lot of great advisors that focus and specialize on growing assets, their clients' assets. They don't really know they as advisors aren't really educated on how to turn that into income. And so they just tell them things like, hey, you can take 4% out, the 4% rule. Well, that's an old rule. It doesn't really work in today's, investment world, in the interest rate environment, with taxes, with inflation, all those sorts of things. So they're not focusing on that sequence of returns risk, which could be positive, but it can be very negative and detrimental, when you take in withdrawals during downturns. And so we're looking at, again, not focus on the average return, but real life, because we're having to take withdrawals when those bills are due. So if you set up a regular withdrawal schedule, you can't time the market. So we're not really looking at what that risk can do and how that can have a downward spiral on your portfolio. And on top of that, there's a lot of emotional decision making when you don't have a true income plan in place for your retirement. You don't have this paycheck, and now we're just going to keep our investments the way they are and sell stocks or whatever, mutual funds or whatever it might be when we need income versus, hey, let's maybe shift part of our portfolio and build a paycheck within our retirement income plan and look at maybe some different investments. It could be investments that generate more income. It could be annuities that have a guaranteed lifetime income. But, retirement does require a different strategy and taking a full look at the overall picture and how do you need to reposition some of those assets. However, that being said, investments are an integral part of a retirement plan because that is an inflation hedge. So they're still super important. Sometimes when we talk to people, some of their questions, as soon as you mention annuity, they say, oh, you're an annuity person, you don't like investments. And that is absolutely not the case with us. So I always make that clear. No, we are very big proponents on the market, but we also know that you need to have some safety in your retirement income plan to provide that safe, guaranteed, reliable, predictable income.
Yep.
Yeah. It all goes back to risk too.
Mm-hmm. Exactly.
So if we strip away a lot of the noise and opinions around this, at its core, an annuity is really designed to solve a specific problem in retirement. But I think where people get stuck is understanding exactly what role is supposed to play within a broader plan. How should someone be thinking about that?
Mm-hmm. Yeah. I mean, what role does it play when it's used correctly?
Well, when it's used correctly, an annuity can provide guaranteed lifetime income. Again, it can serve as a pension, if you will, where you can take a portion of your 401k or your IRA or what savings you have, and now you can have a guaranteed lifetime income such as a pension. And a lot of people don't have pensions these days, or they're a smaller amount. They're not going to cover their needs. And so this can provide that additional base income to cover those essential expenses, the mortgage or the property taxes or the rent, the utilities, the groceries, all those things that you have to cover. And so it really is, I think of it as kind of replacing your paycheck, and the investments that you leave in the market are kind of like your bonus income that you might have, so this gives you stability and predictability, and it can really reduce your stress. So you're not having to look at the stock market every day and you wake up and you go, oh, this has been a bad month, but I still have to take money out, or now it's bad 2 months. And you're worried knowing that you're selling when the market's low, which is the exact opposite of what you should be doing. So in that sense, it can actually reduce stress by knowing that you have an annuity if it fits your situation and it's the right annuity that can provide that safe, guaranteed income. And you don't have to worry about what the markets are doing. The bills are going to be paid.
So to be clear, and this is where people can sometimes get the wrong idea, this isn't about going all in on something guaranteed. That's usually not the right approach either. It's really about balance, having some money positioned for income and stability and some still positioned for growth.
Exactly.
Yeah. Again, we're talking about kind of a seesaw, right? I mean,
right.
Balance is key. And where do investments still fit into your overall picture?
Well, they still fit in because you need growth for inflation. Things today, a loaf of bread, eggs, gas, whatever it might be, it's going to cost a lot more over the next year, 5 years, 10 years, 20 years down the road. So you need that higher growth for inflation. Investments also give you the liquidity and flexibility that you need. So annuities are more predictable, but you're going to have things like a car repair pops up, or you need to replace the roof on your house, or you have a medical expense, or you want to take a vacation, or maybe you want to spoil the grandkids for Christmas, whatever that might be. It gives you that flexibility and liquidity to be able to take money out as needed, but you don't have to take it out if you don't need it, or if the market's down, maybe you spend a little less. So, it's important for that. It's also, investments are important if you want to leave behind a legacy, to make sure that you have that growth, so you're not spending down all of your assets and you're able to leave something for your kids or your grandkids or your favorite charity or whatever that might be. So there's a lot of different reasons. This gives you more of an opportunity, whereas annuity gives you more of that stability piece.
And I think this is where people get tripped up. They try to turn it into a debate, right?
Right.
But it really isn't. It's about understanding what each piece is designed to do and then structuring things in a way that supports your income, plus your lifestyle and your goals.
Absolutely.
So, Shawna, how does someone think about all of this balance?
Well, we start with, with our clients, we put together an actual income plan. So we want to look at things. Hey, we need to cover your needs with guarantees. So we start with your Social Security benefit. If you have a pension, maybe you're working part-time, or you have rental income, whatever the case is. When we look at that, now we know kind of what your base income is. And now we talk about what are your expenses? What's that gap? So we look at that gap and we want to cover that gap for, with guaranteed income. If you're short 2,000 a month or 5,000 a month or whatever that amount is, that's the amount that you need to allocate towards something safe like an annuity. Then with what's left, you can invest the rest of that for growth. Now, inside the growth piece, we want to look at different buckets. So even within that, a lot of people still want to rely, maybe we don't completely cover the guaranteed needs with the annuity, but you want to have some more short-term buckets for those unexpected expenses or things that come up. You want to have midterm where you can invest a little more aggressively for growth. And then you have your kind of long-term, for legacy pushing out down the road, and where you can get a lot more growth up to what you're comfortable with, so that you kind of have these different buckets of when you can pull from different parts of your portfolio. And when you have all these different pieces, you have the safe piece with annuity, you have a short-term bucket, midterm, and long-term. Now that reduces emotional decisions, so that when the market has some volatility, you're not kind of freaking out or panicked or worried, losing sleep at night saying, hey, I need to make changes, and then selling and realizes losses. That allows you to stay invested the way that the plan was supposed to be, and it creates a lot of more clarity for you. So that's what, those are the things that you should be thinking about, and those are the things that we discuss with our clients.
Like anything else, I mean, clarity happens when you remove the emotion.
Exactly.
Mm-hmm.
Yep.
Yeah. So you know what? Let's just say it's not for a lack of effort. That's not what we're talking about here. It's more that the decisions aren't always connected to an overall plan. And that's usually where things start to drift, right?
Mm-hmm.
Well, yeah. And it seems like people can get stuck. Is it lack of information here, or are they just making decisions without a clear plan?
I think it's maybe a combination of both, depending on what type of advisor you might be working with. They might be all on one side of the aisle or the other, where they say everything should all be invested in the market. You don't need that safety, or the vice versa, where you have an advisor who says that the market's too risky. Let's just go all in on annuities. And so it's not being all in, so a lot of times with those, there's no real strategy behind the decisions. Some people, it's because they're kind of doing it themselves and they've done okay so far, and they've done well during their working years. Maybe they just retired, but they still think they can handle that. And so a lot of times there's no strategy, and that's where then all of a sudden something can crop up and they can realize that they're in a predicament, So it's about not you don't want to make fear-based choices. Those are never going to be, it's not going to end up with a good result. And it's partly, people today, there's so much noise out there. There's, on the TV or on social media or from friends or from family or so-called experts, and I'm not trying to put anyone down, but there's so much noise out there and so many different thoughts to think about. And you have to kind of break through that to say, what's the true actual facts here? What's the real advice? Who's really out for my best interest versus maybe they are pushing a product or something like that, and really trying to drown out the noise a little bit and really get down to what's real and what's not, and making sure that your plan is properly coordinated by working with an advisor who goes through all these different things and is actually trained and specialized in it.
So for someone listening to this, these decisions really come down to a few key things. It's taking a step back and understanding what actually matters for your situation before making any moves.
Mm-hmm.
Yeah, this is not a one size fits all. And it's so important to talk with your financial advisor, talk with your fiduciary, talk with your CPA, make sure that you evaluate what's best for your situation. So Shawna, when they do sit down, what should be something that they actually evaluate?
Well, just a couple key things. They want to make sure that you look at your essential expenses. You want to have a good grasp on your actual budget, what's actually needed. You want to take a good look at your guaranteed income sources. Also figure out what is your true risk tolerance, or how much risk are you comfortable with now? Not what you were comfortable with 10 or 20 years ago, but what you're comfortable with today. And then you want to look at the need for income versus growth. And that's going to be dependent on some, your expenses that we just talked about. So how much income do you actually need based on what your income sources are versus how much growth do you need, and the purpose of each dollar. So each bucket or each different type of investment or account should have a different purpose, whether that's for today or for emergencies or for the next, 1 to 5 years, or if it's 20 years down the road, there needs to be a purpose. So it's not just we're going to do these things with no rhyme and reason. And we want to know why you're doing each of them and what that is doing for you.
And when you have that clarity, the decisions become a lot easier and a lot less emotional.
Absolutely, Jacqueline.
I think when you really step back from this conversation, it becomes clear this isn't about choosing one over the other. It's about understanding what each piece is designed to do and building a plan where everything works together the way it's supposed to.
Yeah, and when you actually see it laid out that way, it tends to take a lot of the uncertainty off the table. You're not reacting then. I mean, you're making decisions with purpose and you're planning for it.
Absolutely. And, for those of you that are listening, and if you're not quite sure how this might apply to your situation, that's completely normal. Don't be alarmed. This is where having a simple conversation can make a huge difference. We do offer a complimentary discovery call where we can walk through, what you have going for you, what you're trying to accomplish, and help you see how all those pieces fit together. So you can reach out to us at 833-4-MY-WEALTH, or visit us at more, that's 2 O's and morewealthtalk.com. And if you haven't already, make sure to subscribe to the podcast so you don't miss future episodes.
And speaking of that, go and check out our past episodes because we talk a lot about, not a one size fits all situation. And we talk a lot about how this can fit into your picture.
Absolutely. And remember, you can always give us a call. I do have a book, Retire with More. We're happy to get that copy out to you. And it's kind of a super secret surprise. We do have a book number 2 coming out in the near
future. Let's go. Remember, everybody, move with intent. Take the emotion out. That will take the anxiety out. That's what we're here for. That's why we over-explain things over and over until you're comfortable. Things will be a lot more harmonious that way.
Yeah.
Hey, thanks for joining us today. Yes, Jacqueline.
Hey, Dave, where did we go wrong without the dad jokes today?
We didn't do any dad jokes.
We don't have dad jokes today. No, I heard a good one last night and I forgot it too. Remember we were doing the dad jokes?
Yeah.
Oh,
that's all right.
Man, that was a good one because I thought I should use it tomorrow.
But you didn't write it down.
I didn't write it down.
You're just disappointing me and the listeners.
Dummy me, okay. I let you down. Dummy me thought I can remember it, and I didn't.
Well, when he closes, we'll be like, and for our listeners, sorry, Dave forgot his dad joke, so he gets reprimanded this week.
Yeah.
Okay.
Well, thank you for joining us today. We'll see you next time on More Wealth Retirement Talk.
Thank you all. Thanks for tuning in to More Wealth Retirement Talk with Shawna,
Dave,
and Jacqueline.
We hope you enjoyed the mix of financial insight,
sports wisdom,
and a few dad jokes along the way.
Join us next week for more ways to plan smart,
laugh often,
and retire with confidence.
Advisory services are offered through More Wealth Partners, LLC, an investment advisory in the state of Tennessee. Insurance products and services are offered through More Wealth Management, LLC, an affiliated company.